All right, so if you're a new homeowner, you're probably staring at a pile of tax documents right now, feeling a little overwhelmed, and you should be careful. There's a really common trap involving property taxes that catches thousands of new homeowners off guard every single year. So let's break down exactly what it is and how you can avoid it.
So you get that Form 1098 from your mortgage company, you scan down looking for that big property tax number you paid at closing, and wait a minute, it's either totally blank or way, way smaller than you expected. You know for a fact you paid those taxes, so what gives? And the big question is, did you just lose out on a massive tax deduction?
What's going on here is basically a showdown between two different documents. That Form 1098, it only shows what your lender paid out of your escrow account. But your settlement statement, that big stack of papers you signed, also called the closing disclosure, that tells the complete story. For this deduction, the settlement statement is the absolute source of truth.
So let's just cut right to the chase. Can you still deduct those taxes that aren't on your 1098? The answer is a resounding 100% yes. You absolutely can. You just have to note to use the right document and follow a very specific IRS rule.
You know, this mistake is so common it actually has a name. It's called the closing date trap. And it happens when people assume that whoever physically wrote the check to the taxman gets the deduction. But that's not how the IRS sees it. It's not about who paid, it's about who was legally on the hook for the tax.
So if it's not about who physically paid, then how does it work? How does the IRS actually decide who gets to deduct what part of the tax bill? Well, it all comes down to a surprisingly logical rule.
Everything hinges on what's called the day of sale rule. The IRS basically takes the entire annual property tax bill and slices it up like a pie. The size of your slice is determined by the exact number of days you owned the property during that year. Who actually mailed the check is completely irrelevant.
And here's the crucial part of how that split works. The seller is considered responsible for all the property taxes for every single day of the year up to, but not including, the day you closed. You, the buyer, are treated as being responsible for the taxes starting on the day of sale and for every single day after that. And look, this isn't just some clever accountant's theory. It's written right into the law. The U.S. tax code itself, Section 164 to be exact, spells out precisely how this division works. The law literally says the tax is treated as a tax imposed on the seller for their portion of the year. It's crystal clear. So, this all brings us back to that stack of papers on your desk. For any taxes that were handled at the closing table, you have to take that Form 1098 and just set it aside for a moment. Your real guide, your source of truth, is your settlement statement. Okay, so how do you figure out your exact number? It's way easier than it sounds, really just a simple three-step process. First, find that line on your settlement statement showing the total annual property tax. Second, just count the days you owned the home that year, and remember to include the closing day itself. And third, you just do a quick calculation to figure out your prorated share. Let's walk through a quick example to make it real. Let's say the total annual tax bill is $3,650. Nice and easy, that's $10 a day. And you closed on September 1st. That means you own the house for 122 days of the year. So you take your 122 days, divide by 365, and multiply that by the total tax. And boom, your deductible amount is $1,220, even if your Form 1098 says zero.
Now, I know what you might be thinking. Closings aren't always that clean and simple. There are a couple of common curveballs that can make things a bit confusing. But don't worry, the main rule still applies. Okay, this slide is critical. Let's look at two scenarios. First, what if the seller had already paid the entire year's taxes before you bought the place? Well, the money you paid them back at closing for your share of the year is deductible by you. That's your tax expense. But now the second scenario. What if you agreed to pay the seller's delinquent back taxes from a previous year? That amount is absolutely not deductible. Instead, that payment just gets added to the cost basis of your home.
You might be thinking, wow, this is a lot of effort for one deduction. But trust me, getting this right has ripples that can affect your entire financial picture. And this is especially true for anyone near or in retirement.
In fact, tax professionals have a pretty dramatic name for the cascade of problems that a disallowed deduction can cause. They actually call it the double torpedo.
And here's how it works. It's a nasty chain reaction. First, the IRS says, nope, we're disallowing that improper property tax deduction. That immediately makes your adjusted gross income, or AGI, go up. Well, that higher AGI can suddenly push you over a threshold that makes more of your Social Security benefits taxable. And it gets worse.
That same higher AGI can also trigger some seriously expensive surcharges on your Medicare premiums. It's a terrible domino effect.
And that hit to your Social Security can be huge. We're not talking pocket change here. Depending on your income level, a disallowed deduction could suddenly mean that up to 85% of your benefits are now subject to income tax. That's a massive financial hit from one small mistake.
Okay, I know that was a lot to take in, so let's boil it all down and put this all together into a simple, clear action plan that you can use when you're actually doing your taxes. Here it is, your 3-step takeaway. Number 1, trust but verify. Use your settlement statement, not just your Form 1098, as the final word. Number 2, do the math. Calculate your share based on the number of days you owned that home. And number 3, claim it with confidence. Add that amount to any other property taxes paid from your escrow and report the grand total on your Schedule A.
Getting a handle on the closing date trap is a huge step toward becoming a more savvy homeowner. But it does make you wonder, doesn't it? What other hidden rules and little tax traps could be out there quietly having a big impact on your bottom line?